it shouldn't be that controversial because I'm relying on some fairly well-established propositions in monetary economics. But if you followed the news in late 2008 and then looked at these three propositions, you might have scratched your head a little, because this certainly was not the standard view in the news media at the time. And here's another example I like, a quotation from one of my favorite economists, Milton Friedman, during the Japanese liquidity trap period. He pointed out that he takes a contrarian view. Low interest rates are generally a sign that money has been tight. Now, how could he make this claim? Well, notice he says has been, not necessarily is. So if you've had a tight money policy, that can depress spending in the economy, leading to lower output and lower inflation. And both lower output and lower inflation tend to depress interest rates. Because I spent a lot of my career studying the Great Depression, this didn't seem too surprising to me. In the Great Depression, interest rates fell almost to zero and stayed there for quite a long period of time, mostly reflecting weaknesses in the economy. But at the time, people thought that the Fed was providing easy money in the Great Depression. So there was a perception that the Fed was doing a good job. Later on, Milton Friedman and Anna Schwartz wrote a book that presented a new view of the Great Depression, arguing that actually money was tight and people were looking at the wrong indicators. And so this new view has become somewhat accepted. In fact, Ben Bernanke, I don't remember the exact quote, said something at a dinner honoring Milton Friedman something like, well, you were right, we did it, we're sorry, and we'll never do it again. Bernanke, of course, referring to the Federal Reserve. And so, anyway, Friedman was surprised during the Japanese liquidity trap, if you want to call it that, of the late 90s and early 2000s, that people just assumed the Bank of Japan had done all they could, and that there was easy money in Japan, whereas he argued exactly the opposite. Monetary policy was contractionary. Now, some people will respond to me and say, well, yes, we know nominal interest rates can be misleading, but you can always look at real interest rates. And surely that would tell us whether money is easy or tight. I actually have two responses to that. One, even real interest rates can be misleading because they will tend to fall during a severe recession, a severe downturn in the economy, because businesses are doing less borrowing, there's less demand for credit. But if we want to talk about real interest rates, let's look at what happened to them between July and the beginning of December 2008, when this sharp contraction took place that I've already showed you. Now these are real interest rates. How do we know that? Because they're interest rates on what are called index bonds. Index bonds pay you a specified real rate, and then the actual return you get includes an inflation adjustment computed after the fact, when inflation is measured. So the basic rate on an index bond is in fact the real interest rate. Those rates rose, from less than 1% on 5-year Treasury index bonds in July to just over 4% at the beginning of December, the end of November. And then they started to decline as the economy got weaker. So if real interest rates are the right indicator, monetary policy actually could be argued to have been very contractionary. Now, Frank from Michigan mentioned in the textbook that you have to look at other indicators besides interest rates to really see what's going on, to see the stance of monetary policy. And he mentioned looking at other asset prices. So here's an example of a different type of asset price, commodity prices. These are very sensitive to market conditions. They're flexible. They move up and down day by day. And what I'd like to point out here is that commodity prices peaked in the middle of 2008, around July. You may remember back in 2008 that oil prices got very high and you were paying, I don't know, in California it's higher than, maybe up to $5 a gallon at the peak or something close to that. And then they fell for a while, and now they've been coming back up again. So you see big fall that took place between July and December. Back up a little, and this graph is out of date. They're higher now than, and all commodity prices have gone up. But I just wanted to focus on the big drop. And this, I don't know if you can see the scale here, but this is more than a 50% drop. Commodity prices fell in half. The value of the dollar is another interesting asset price that can tell us whether money is easy or tight. And during late 2008, this is what happened to the trade-weighted exchange rate, meaning the value of the US dollar against the basket of other currencies, sort of the average exchange rate. You can see that starting in the middle of the year, it's at around 96 on this index, and at the end it's over 110. So maybe a 15% appreciation of the dollar just in a short period of about 6 months. That's a very strong appreciation. And one of the things that's kind of interesting about this is sometimes people argue against my hypothesis, and they make this argument. They say, well, look, how can you blame monetary policy for playing a role in this? Because if you have a severe financial crisis, you almost always have a severe recession. However, the vast majority of those financial crises around the world, in places like Thailand and Mexico and Russia and so on, are situations where the currency of the country in question depreciates in the teeth of the crisis. It falls. It reflects weakness in the economy. It's very rare to have a financial crisis of this sort and see your currency rising dramatically during the crisis. A couple previous examples that I can think of is in the early 1930s, the US dollar was strong in real terms during the crisis, the banking crisis. And Argentina, about 10 years ago, when they had a period of deflation and banking crisis, their currency was strong in real terms. It was fixed to the dollar, which was appreciating at the time. Interestingly, those two previous examples are both cases where many people in retrospect feel that policy was too tight, too contractionary. US in the early 30s, Argentina around the year 2000. So it's a little bit different from the ordinary financial crisis. And here's some other asset markets. Stock prices crashed in late 2008. The second half of the year saw an enormous decline in stock prices. Commercial real estate prices, I think, are a very interesting indicator because unlike housing, the commercial real estate market stayed strong throughout 2006, 2007, and even the first half of 2008, when housing was already declining very significantly. Why was commercial real estate strong during this period? I would argue that it wasn't as affected by the subprime bubble, and that when it did decline sharply, it was reflecting weakness in the economy. So, whereas the earlier declines, and by the way, I don't know if you're familiar with the term subprime bubble, most economists separate out two parts of the housing market. Areas like Florida, Arizona, Nevada, and I think you call it the Inland Empire here, where housing prices got very inflated and then crashed sharply, was what I talk about as being a bubble unrelated to tight money or anything like that. That was a crisis that was going to happen based on mistakes made earlier. But the commercial real estate market, I don't think, had to crash. I think it crashed partly because of the severe recession that began in the second half of 2008. Also, the U.S. has a very complicated real estate market for residential homes. There were some areas like the heartland of the United States, most famously Texas, that did not see a housing bubble. Housing prices did not soar because there was plenty of land to build. And in those areas, housing prices did not fall during the 2006 to 2008 subprime crash. However, in late 2008, prices fell a little bit even in Texas. My explanation would be that's reflecting the weakening national economy. So we sort of have two situations here. We have a subprime situation, which is sort of localized, although it affected the whole U.S. to some extent. And then other asset markets like residential real estate in the heartland commercial real estate, stocks, commodities, these sorts of assets that reflected monetary policy and economic weakness in the last half of 2008. And then finally, the TIPS spreads. These are the gap between the interest rate on a regular treasury bond, a conventional bond, and an index bond, which is the real interest rate I just referred to. So if the interest rate on a regular bond is 5%, if it's 2% on an index bond, the gap, the 3% gap, represents expected inflation, what investors think inflation will be over that period of time. During this period, in late 2008, that spread fell very, very sharply. In fact, it went negative for some types of TIPS. That is, there was a short period of deflation expected by the financial markets. And in fact, the consumer price index did fall between mid-2008 and mid-2009. So that was quite a turnaround from fairly rapid inflation in early 2008. So one analogy I use is that it would be like someone that had a cold that turned into pneumonia. We had a certain problem, a subprime crisis, and it morphed into a bigger problem, a lack of nominal spending or aggregate demand in the second half of 2008. And we were still treating it as if it was a cold that had just gotten worse, whereas it was actually an illness that maybe required antibiotics or something. Couldn't be treated the same way. And because it looked similar, it was natural for people just to think the problem, quote, the problem is getting worse. In my view, there's more than one problem here. And, well, what would be the other analogy I sometimes use is someone is suffering from pneumonia, they're walking to the hospital to get treated, and on the way there they get stabbed. And they are brought into the emergency room, and the doctor says, there's no need to treat this knife wound. The patient's real problem is pneumonia. Well, a problem is pneumonia, but also another problem is a knife wound that needs to be treated. And I think that the U.S. economy in late 2008 suffered from two problems. A financial problem, having to do with the banking system and its exposure to subprime mortgages, and an aggregate demand problem that wasn't fully recognized as being separate, that could be dealt with separate tools. To use maybe one more analogy here, when the Federal Reserve in late 2008 was trying to rescue the banking system, I don't think they were addressing the fall in nominal GDP, the fall in aggregate demand. As a result, it was like bailing water out of a boat without first plugging the leak through which water is coming into the boat. So they were sort of trying to bail out the banking system, and then every time a month later they would go, the problem seems to be even worse. We've done all these things to fix it, and the estimated losses are even larger than before because of the weakening economy increasing the size of that. And I'll present some data in a minute to show you that pattern. Okay, a few comments on bubbles. I have a sort of a contrarian view of bubbles. I'm not going to argue that the people are wrong about the United States, and especially the subprime states being a bubble. But I would just caution you that bubbles are not always as easy to spot as you might think. I just pulled this graph off the internet, but I didn't sort of cherry pick these 4 countries. If you'd taken a bunch of European countries, I could have shown you the same pattern. And the pattern I'm going to try to show here, it's going to be hard, but right about here in 2005, a lot of people were calling a bubble. Okay. And if you look at these 4 countries, the blue line represents the United States housing market, the average housing price. Clearly those who warned about a bubble were correct for the United States. Prices today, and this is again not quite up to date, but they're still much lower than they were in 2005, even though they went up a little bit first in 2006. And then there's 2 other countries, New Zealand and Britain, where prices have sort of zigzagged but are about the same as they were in 2005, even though they also had seen sharp run-ups to that period. Australia